Hello everyone, welcome back to our Accounting 210. In this video, we continue with the chapter 9, the master budget. Last time we talked about the second learning objective, preparing the operating budget. And then we talk about the sales budget. That's the first budget you have to prepare, but we focused on the production budget. So one more time, a general idea is, I say for January, you need to sell 30,000 units. But that's not the units you produce because you want to have 2,000 units as your ending inventory for the safety stock. So you totally need 32,000. But before you have the production, you already had 3,000, the beginning inventory from last December. So you totally need to produce is 29,000. Okay, units sale plus the ending inventory is the total units you need minus the beginning inventory, that's your production, 29,000. Okay, and I also mentioned that next month sales time, the percentage gives you the ending inventory. This month, the sales time, the percentage gives you beginning inventory because this month sales is your previous month, the ending inventory. Previous month ending inventory is your this month beginning inventory. Okay. So now let's get started. I said you still need to pay a little bit attention for your first quarter. Why? Because you can say the sales is your January plus February plus March gives your first quarter. Nothing really much to say. But your ending inventory, okay? So your ending inventory, March 31st is the ending inventory for March, and it's also the ending inventory for first quarter. So your ending inventory of your first quarter, your ending inventory of your first quarter is the ending inventory of March. And then next thing, let's continue. So that gives you the total you needed. But beginning inventory, January 1st, is the beginning inventory of January, but also the beginning inventory of your first quarter. So your beginning inventory, how do I change color? Sorry, I changed it here. So your beginning inventory of your January, is also the beginning inventory of your first quarter. Okay. So make sure you know those two parts. So basically, one more time, is your ending inventory of your first quarter is ending inventory of March. Beginning inventory of your first quarter is the beginning inventory of January. So that's how you do your first quarter number of units to produce. Okay. So that's it. One more time, you definitely will have a question for production budget. Make sure you practice with your textbook with my accounting lab. Next one, talking about the direct material, right? Because once we have a production, how do we produce? We need a direct material budget. We need direct labor budget. We also need a manufacturing overhead budget. So for this course, I'm not going to talk about those things in detail because I know you already have a lot of things on your plate. So I'm not going to make your life more miserable. But I want to go through this, give you the general idea so that if you later you need this information, you can learn by yourself. The logic is similar. It's basically your direct material needed to produce plus your ending direct material inventory gives you your total inventory, total material you need minus beginning direct material gives you the direct material to purchase. Okay, I'll go through very briefly, quickly. So we focus on the production. Right now we just use production. January you need to produce 29,000 units. And then each unit you need to have 5 pounds of the flour. So totally you need 145,000 pounds of flour. adding your desired ending inventory of your direct material. So you kind of use your next month production, you get your ending inventory for your direct material. You found out you need to have this as your ending material. So totally you need 155,250 pounds. That's the total direct material you need. But you also have the beginning inventory. So your totally you need these pounds minus the beginning pounds you already had, get the total pounds you need to purchase. So we need to purchase 140,750 pounds to produce our product. So similar logic, right? One more time, is the units you need to produce plus your ending inventory minus your beginning inventory. So that gives you the direct material you need to purchase. Okay, and then similarly, the first quarter, your ending inventory is your ending of March, and then your beginning inventory is the beginning of January. For direct labor budget, it's easier. So it's basically we found out how many units we need to produce, and then time the for each unit how many hours. So that gives our totally hour we need, and then time the salary time each hour how much we pay for our employee. You get the direct labor cost, right? Dollar amount. We said for each case it takes 0.05 hour to produce. And then every hour we pay our employee $22. So we totally need to produce 29,000 cases, and each case takes 0.05 hour. So totally we need 1,450 hours, and each hour we pay $22. So we totally need to budget $31,900 for our direct labor. Okay. Next one, talking about manufacturing overhead budget, right? We said the manufacturing overhead. I hope you still remember this terminology from chapter 3. It heavily depends on the cost behavior. So some will be variable, and then some will be fixed. So we have oil, all those things you can find out, and the salt, all these spicy things. For each case, we need $1.25, and we totally will produce 29,000 cases. So for this, we need $36,250. For the utility and the indirect labor and other costs, we said some will be we separate, right? So we said for the variable cost is 75 cents, for the utility is 50 cents. For each case, totally we still need to produce 29,000 cases. And then depreciation, insurance, those things are fixed cost. So we just put fixed cost regardless of how many units we will produce. So let's go look at January. We need to produce 29,000. And then for variable cost, indirect labor, utility, we got our total variable manufacturing cost. Our fixed cost, we have depreciation, insurance, indirect labor, utility fixed part. So we got our total fixed cost there. And then our budgeted manufacturing overhead cost for January will be $102,500. Okay, I think I stop here. For operating expense, we have something there I want to focus a little bit. So we talk about that one in the next video. But this video, general idea is I go through those budgets to give you a brief idea. You are not required to know the calculation, but I want you to get a general idea. Watch this video, read your textbook. I think that is all, just in case if you have any multiple choice, but you don't have any calculation from this part. Okay, I stop here, and then let me know if you have any question. I see you next time. Thank you.